Hello everybody, this is Mike Rixey. I am the lead options instructor for NetPicks, and I want to show you here today how you can take a trade on Tesla, which is one of the most popular stocks in the marketplace right now, for as little as $350. I want to show you how you can structure the trade, how you can put the trade on in a very safe way, and give yourself a very high probability of success here over the next couple of weeks. So let's go ahead and dive in. Over the past 6 to 8 months, we have seen some historic moves in both directions. We have seen big moves higher and lower on Tesla specifically, which has made it a phenomenal product to trade. I get questions on this stock all the time. People want to be engaged in this market because of the big movement, because of the profit potential. The trouble right now is that because of the big movement to the upside of late on Tesla, this product is incredibly expensive. The options are expensive, and it ties up a lot of capital if you're not careful. I want to show you how you can simplify. A lot of people go immediately to the penny stocks because that's what they think they can afford. I want to show you how you can stay active in some of these higher price stocks with a fraction of the capital. Let's start out with a chart of Tesla. This is the 195-minute chart. This will give you 2 candles a day instead of the typical one that you get with a daily chart. It's our preferred time frame. It's one that we have found identifies the swings really well without getting caught up in some of the chop that can kick in with some of the shorter time frames. And what we're looking at here is the far right edge of the chart. We're looking at the most recent price action, and really going back over the past month, you can see it's been a phenomenal move on Tesla from right around 400 all the way up to around $650 earlier this week. That's a huge move. It's one of the biggest stocks in the market, but it's trading like a penny stock. It's been amazing. As a result, price in the near term is incredibly overbought. How do we quantify that? One of the indicators that we love to use is what we call our pulse histogram. It's the red and yellow histogram down at the bottom. Notice here over the past week, we have had a whole slew of yellow bars. What that indicates is price is between a 1 and a 2 standard deviation move on the upside. Now, if that's confusing to you, you don't understand what standard deviation is, all it means is price has hit a point on the upside that will typically lead to either a sideways period on Tesla or even a reversal in the other direction. The stock is tired here. It doesn't mean it can't head higher long term. It just in the near term, we're at an exhaustion point. Very typical to see a stock pull back and rest from these levels. Notice also that over the past couple days, we have seen price move below that red and blue line up at the top. All that is there is the 8-period exponential moving average. It acts as support and resistance quite often. Once that price breaks on the downside in this case, it will typically lead to further downside follow through. That's what we're expecting over the next week or two, and I'm going to show you how to capitalize that in just a moment. Now, whether you're using our pulse indicator or you're using any other indicator or chart pattern out there, it's easy to identify this extreme on the upside because it has been so big. I don't care if it's another indicator that's not a NetPicks indicator, as long as we come to the conclusion that we want to be in more of a neutral to bearish position. How do I go ahead and do that with an option? Well, let's go ahead and take a look at a slide here really quick. Just a quick screenshot that I want to show you. There's multiple types of strategies that you can use with options. You could come in and just buy a put option, looking for Tesla to move to the downside. If it does so, you can make a really nice return. The problem with that, there's 2 main problems. Number one, they're incredibly expensive, which you'll see in just a moment. And they also only give you one way of making money. Buying long calls and long puts, as you'll see here on the right, that is the most aggressive strategy you can use. You do have the most profit potential, which we all love, but it also comes with the most risk. You've got to be aware of that. Not saying it's a bad thing, you just have to be comfortable with that. I will buy long calls and long puts, but only with a portion of my portfolio. There's other option strategies that I love to use that will give me a better probability of success and also tie up less capital, specifically using vertical spreads. I can use a debit spread. I can buy a vertical spread to lower the cost by 30 to 50% in many cases. In exchange, I am giving up some profit potential, but it's a fair trade-off. If I can lower the cost of the trade by 30 to 50%, that's huge for a lot of retail traders. I'm going to take it one step further. We could actually use a credit spread, and all that means is I'm selling a vertical spread to open up the trade. It's going to give you the lowest amount of risk. Yes, it's going to give you the lower profit potential, but you're going to have the highest probability of success, and you're also going to give yourself 5 ways of making money on the trade. And I will show you just how to do that here in the next couple of minutes. So I'm not saying you should only buy calls and puts or you should only use credit spreads. The power kicks in, guys, when you use a mix. When you have a wider range of strategies that you can go to, you're going to better be able to react to different types of market conditions. It also opens up a whole new universe of products for those of you that might have a smaller account size. So let's show you how we can go ahead and take this chart pattern, take this overbought condition on Tesla, and piece together a trade for $350 or less. I'll show you how to do it. I'm going to use Thinkorswim for this example. You can use any broker platform out there. Doesn't matter. I know a lot of people like to use Tastyworks, Fidelity. Doesn't matter to me which broker platform you're using. I'm just going to show you the mechanics here inside of the Thinkorswim platform. Well, if I go to the trade page and open up Tesla, if I were to just by default come out to the January monthly options, those are the ones with 35 days left. If I were to come in and try to take a look at buying a long put option, let's just say I went to the 610 put. Those are currently trading for $75 or $7,500 per contract. It would give you a tremendous amount of profit potential, but it would tie up $7,500 of your capital just to buy an individual contract. It's expensive. It only gives you one way of making money as well. You need Tesla to make a big move lower. That's the only way you can do it. Well, for those of you that might have a smaller account size, maybe you've got a $5,000 account, clearly this is not a potential trade for you because you don't have the capital to do it. Well, I don't want you to just throw Tesla out of the equation because it's a great product. It's one of my favorite products to trade right now, and I don't see that changing anytime soon. Going into next year, Tesla is going to be at the top of my watch list on a regular basis. So what else can we do? A lot of times people will just go to the cheap out of the money options. Well, go to the out of the money options that only have 7 days left to expiration. Maybe we go all the way out to the 540 puts out next week. The options with 7 days left. Now you're talking about $1,600 of capital. A little bit more reasonable, right? But still expensive. It's still a very aggressive trade. What if I want to be more conservative? What I'm going to do is I'm going to take a look at using a credit spread. And we're going to go ahead and utilize the December 24 weekly options. Those are the ones with 13 days left to expiration. It would give us 2 weeks for this trade to work out in our favor. Let's go ahead and open those up. Another way of putting on a bearish trade instead of just buying an outright put is let's go ahead and sell an out of the money call spread. All that means is I'm trading 2 options at the same time. I'm going to go to the out of the money call options. I'm going to sell an option that's closer to the current stock price, and I am going to buy an option further out of the money to make sure I am in a risk-defined trade. I'm going to come all the way out to the 650 calls. I'm going to right-click on those calls. I'm going to go to sell, and I'm going to select a vertical. And down at the bottom, I'm going to go ahead and change the price. Price is all over the map here, so we're just going to go ahead and call it $1.60. Right? All I'm doing here with this trade is I am selling the 650 call and I am buying the 655 call at the same time. The goal for Tesla here is to stay below $650. That's the strike price of the option that I'm selling. Tesla right now is trading for just over $600. I have a $50 cushion over the next 13 days that I can be dead wrong and I can still make money. The only move that hurts me is a big move above $650 over the next 13 days. That's not something I'm expecting because as we looked at on the chart, it's already overdone. It's already overbought. I'm actually looking for a pullback to the downside. All right. So let's click on confirm and send and let's take a look at this. By selling the 650 call and buying the 655 call at the same time, I would be collecting $1.60 or $160 per spread. It would tie up $340 of my capital per spread to put the trade on. I'm still controlling 100 shares of Tesla stock. I still make money if it moves to the downside. But now, instead of tying up over $7,000 to buy the long put, I'm tying up $340 by using the credit spread. So you take a look at that, and all of a sudden, that's very reasonable, regardless of your account size. If you've got a $5,000 account, this trade is still very much doable. All right. Now, you look at that risk reward, you're saying, okay, risk 160 to make 340. right around risk 2 to make 1. Why does that make sense? A lot of times people are taught, make sure your winners are larger than your losers. Make sure the winners, you give them a chance to run in your favor. With a credit spread, I am comfortable risking 2 to make 1 because we have 5 ways of making money on this position. I make money if Tesla moves up, down, or sideways. I don't care as long as price stays below $650. I make money. And actually, I can take it a step further. Our actual break-even point's at $651.60 because we've got to factor in the credit that we're collecting to put the trade on. As long as Tesla stays below $651.60 over the next 13 days, we make money. If we get a big move lower, great. If we just chop sideways, we can work with that. If we're dead wrong and Tesla moves to the upside, we're still okay there as well, as long as price stays below $651.60. Lot to like about this trade. We also make money as time decay adds up. Every day that passes, that helps this position. And I make money if volatility decreases. Those are my 5 ways of making money on the position. Now, yes, I'm giving up my home run profit potential. If I were to buy the long put, yes, it's tying up a lot of capital, but it's giving me a huge profit potential. It's a high risk, high reward scenario. With the credit spread here, the most I can make is $160. If Tesla completely falls out of bed here over the next 13 days, the most I can make is $160. It's a fair trade-off giving up that home run profit potential because, again, I'm only tying up $340 of capital per spread. That is the most I can lose on the trade. If I am dead wrong, the most I'm out is $340. And the only way that I would lose the entire $340 is if I hold all the way to expiration. If the trade goes against us over the next 13 days, we could always close it out early and take the partial loss if we wanted to. Okay, so a lot to like about this trade. How do we manage it? The first option would be to hold for the next 13 days. Looking for Tesla to stay below $650 that whole time. If it does, we would keep the entire $160. The problem there is it would require me to hold all the way up to expiration. That's not something I typically like to do. It's just too much risk as you get closer to expiration. What I prefer to do is to close this trade out when I can book between 50 and 75% of my max profit. If $160 is my max profit, if I can buy that thing back between $40 and $80, between 40 and 80 cents per spread, that would allow me to keep between 50 and 75% of my max profit, book the partial profit, free up the capital for the next trade, and not have to worry about the stress that comes from holding to expiration. If I get filled at $1.60 here, I would create my closing order immediately at 40 cents. Create that closing order at 40 cents so that at any time over the next 13 days, if the spread trades there at 40 cents, I can get filled and it doesn't take a ton of time to manage. I don't have to sit there and babysit this trade all day, every day. All right? What if the trade goes against us? Again, the most I can lose is $340 per spread. But if I close the trade out early, I can take a partial loss. If you want to use a fixed stop level on a credit spread, we would recommend using the 60 to 70% level. If you start to use a tighter stop, a lot of times people will talk about using a 30% stop. With a credit spread, you're going to get whipped in and out of trades too quickly. What I'd rather have you do is give the trade room to breathe, use a 60 to 70% stop. If the trade hits that level, take it off, lick your wounds and move on to the next trade, right? Live to fight another day. All right. So again, this is a neutral to bearish position. We have 5 ways of making money on the trade. We're controlling 100 shares of Tesla for $340. Our maximum profit is $160, and we make money as long as Tesla stays below $651 a share. So a lot to like about this trade. I much prefer retail traders use this type of a trade. It's just a better way to control your risk, and it opens up the door for some of the higher price stocks in these types of market conditions. When you get to an overbought extreme like this, prices get very, very expensive. This is a great strategy to have in your toolbox to use to lower the cost of the trade. Don't immediately go to the cheap out of the money options. Don't immediately go to the cheap penny stocks. Trade the quality stocks, trade the high flyers. Just utilize these proper strategies to reduce your risk. So if you have any questions on this trade, I'd love to connect. I'd love to help you more with this strategy. Feel free to email me. Mike@netpicks.com is my email address. You can always leave a comment here on the video or on the blog, and we can certainly reach out that way as well. So we'll take a closer peek at this trade here over the next couple of weeks. We'll recap this one in one of our future videos, just so you know how we plan on managing it. So hopefully you found this video beneficial. I'll be back with you guys here over the next few days for our next video.